Welcome, everyone, to week 3 of Case Studies in Finance. This week, in the discussion board, we will focus on H.J. Heinz and estimating their weighted average cost of capital during a period of uncertainty. The goal is to explore how changes in the market environment might impact the calculation of weighted average cost of capital, a key metric used in evaluating investment decisions. This case study will help you understand both the theoretical and practical applications of weighted average cost of capital in real-world financial situations. The analyst at H.J. Heinz is tasked with estimating the company's weighted average cost of capital given recent market changes. This case provides us with a perfect opportunity to understand the weighted average cost of capital calculation process, as well as discuss assumptions and implications of this calculation. Analyzing the weighted average cost of capital, or WACC for short, changes over time for Heinz, and then we will compare those changes with competitors like Kraft, Campbell's Soup, and Del Monte. During this case study discussion, we will analyze how Heinz's weighted average cost of capital evolved from 2009 to 2010. We'll also compare Heinz's WACC to that of key competitors such as Kraft Foods, Campbell's Soup, and Del Monte, while we explore the importance of these changes and discuss the implications for corporate decision making. Weighted average cost of capital in a changing market. Market conditions can significantly influence a company's weighted average cost of capital, or WACC, as it reflects the current cost of raising funds through both equity and debt. For Heinz, fluctuations in the risk-free rate, equity market premiums, and bond yields must be considered when calculating WACC. As financial markets undergo shifts due to economic uncertainty, companies like Heinz must reassess their WACC to maintain accurate benchmarks for evaluating new investments. One major influence on WACC during uncertain times is the fluctuation in interest rates, which affects both the cost of debt and the risk-free rate component of the cost of equity. For example, during periods of economic downturns or market volatility, central banks may reduce interest rates to stimulate economic activity, which can lower the cost of debt. This was observed during the 2008 financial crisis when interest rates fell sharply, affecting the weighted average cost of capital calculations for many companies, including Heinz. Additionally, changes in the equity market risk premium can alter WACC calculations. The equity market risk premium reflects the extra return investors demand for holding stocks over risk-free securities, and it tends to increase during periods of market uncertainty due to perceived higher risk in the equity markets. Heinz's weighted average cost of capital would need to account for these shifts in investor expectations when updating its capital cost estimates. WACC calculation and implicit assumptions. The formula for WACC combines the cost of equity and the cost of debt, weighted by their respective proportions in a company's capital structure, as shown in the WACC formula on this slide. However, these calculations are influenced by various assumptions, which can introduce uncertainty, such as the cost of debt. This is often calculated using current corporate bond yields. For Heinz, one key decision is whether to use short-term or long-term debt rates. Since WACC is typically used for long-term investment decisions, using long-term debt rates is more appropriate as it better aligns with the time horizon of most corporate projects. Cost of equity. Determining the cost of equity involves using the capital asset pricing model, or CAPM, as shown in the next formula. In this calculation, the risk-free rate can be derived from the yield on long-term government bonds, while beta reflects Heinz's sensitivity to market movements compared to its peers. The equity market risk premium is more subjective and may differ based on historical averages or forward-looking estimates. Another critical assumption in weighted average cost of capital is the capital structure, which represents the ratio of debt to equity financing. For Heinz, maintaining an optimal balance between debt and equity is crucial as it impacts both financial flexibility and the overall cost of capital. Challenging issues that are often overlooked. There are several overlooked challenges when calculating and using weighted average cost of capital. Market conditions and time sensitivity are one of these. WACC is often viewed as a static figure, but in reality it should be reassessed periodically as market conditions evolve. A company's cost of capital can fluctuate due to changes in the economy, interest rates, and market volatility. Failing to update WACC regularly can lead to flawed investment decisions, especially during periods of high uncertainty like the 2008 financial crisis. Short-term versus long-term debt. While many companies rely on both short-term and long-term financing, the WACC calculation typically assumes that all debt is long-term. In practice, however, companies may need to refinance short-term debt, which introduces a rolling cost. This complicates the WACC calculation, as the cost of refinancing in the future could be higher or lower depending on interest rate movements. Industry comparisons. A company's WACC should reflect its specific risks and capital structure, but it is common to compare WACC across industry peers. While useful, these comparisons may overlook significant differences in risk profiles or business models between firms. For instance, comparing Heinz WACC to that of Kraft Foods or Campbell's Soup may not fully account for differences in geographic market exposure or product mix, which can lead to incorrect conclusions. There is also beta sensitivity. Betas are backward-looking and based on historical data, which may not accurately predict future risk. Heinz's beta could be affected by structural changes in the company or the market, meaning past performance is not always a reliable indicator of future risk. Although WACC is an essential tool for investment decision-making, it comes with assumptions and challenges that financial managers must carefully navigate, especially in uncertain markets. The weighted average cost of capital represents the minimum return required by a company's investors and serves as an opportunity cost when evaluating new projects. Understanding how to calculate and interpret weighted average cost of capital is crucial for making informed financial decisions, especially in a dynamic market where variables like cost of debt and equity fluctuate frequently. Finance gives meaning to the math of discounting. At the heart of corporate finance is the concept of discounting future cash flows to their present value. This is where weighted average cost of capital becomes a critical tool. It is used to discount a company's projected free cash flows to determine the present value of future financial returns. Weighted average cost of capital acts as the discount rate in the valuation of projects or the overall business, as it represents the blended rate of return required by both equity investors and debt holders. The importance of using WACC is that it directly ties finance theory to decision-making in capital investments. The formula shown on this slide helps break down this concept into a practical application. Within the WACC formula, each future period's free cash flow is discounted by WACC, which takes into account both the cost of debt and the cost of equity. We discount free cash flows, known as operating cash flows, at the weighted average cost of capital to get a measure of the value associated with a financial decision. Think of WACC as the hurdle rate that a company must achieve to satisfy its investors. If a company's return on a potential project or investment does not exceed the weighted average cost of capital, it will fail to add value to the firm. This is why calculating WACC correctly is critical for proper financial decision making. The discounting of free cash flow reflects how much value a company is creating based on the riskiness of its cash flows and the required returns from both debt and equity providers. Free cash flows in this formula represent the cash a company generates from its operations that is available to distribution to investors after accounting for expenses, taxes, and necessary capital expenditures. For example, if Heinz is evaluating a new product launch, it would estimate the free cash flows from that product and discount them at the company's weighted average cost of capital. If the discounted value exceeds the investment cost, the project should proceed. If not, it may be unwise to pursue. The ultimate purpose of WACC is, of course, to provide meaningful input for the valuation calculation. WACC is not just a theoretical tool. It plays an essential role in determining the net present value, or NPV, of projects, acquisitions, and investments. The purpose of WACC is to ensure that the valuation process incorporates both the cost of debt and the cost of equity while reflecting the risk profile of the firm or investment. When using weighted average cost of capital in practice, keep in mind the following. It acts as a benchmark to evaluate investment projects. If the expected return on a project exceeds the weighted average cost of capital, it should create value for shareholders. On the other hand, if the return is below the weighted average cost of capital, the investment may destroy shareholder value. In capital budgeting, this means that weighted average cost of capital provides the cutoff rate for determining which projects are worth pursuing and which are too risky or unprofitable. Therefore, the weighted average cost of capital must accurately reflect the risk-adjusted required return from both debt and equity holders. Furthermore, weighted average cost of capital plays a critical role in mergers and acquisitions. When valuing target companies, firms often use WACC at the discount rate or as the discount rate when calculating the present value of the future cash flows for the business being acquired. An accurate weighted average cost of capital ensures the acquirer is not overpaying based on unrealistic assumptions about required returns. A key takeaway: weighted average cost of capital is indispensable in corporate finance as it provides the discount rate necessary to value future cash flows and make strategic financial decisions. It incorporates both the cost of equity and the cost of debt, ensuring that the firm accounts for the required returns of all its capital providers. In uncertain times, or when the market conditions change, reevaluating weighted average cost of capital becomes vital to maintaining a firm's ability to make sound financial decisions and maximize shareholder value. The weighted average cost of capital formula combines the cost of debt and the cost of equity, weighted according to their proportions in the company's capital structure. A brief summary of the WACC formula is shown here. Keep in mind, cost of debt is often derived from corporate bond rates. Cost of equity uses the CAPM, or capital asset pricing model, factoring in the risk-free rate, the company's beta, and the market risk premium. In the case of Heinz, we will use a 10-year government bond rate as the proxy for the risk-free rate, while beta and the market premium will need to be estimated based on industry data. Assumptions about the cost of debt. The cost of debt represents the effective rate a company pays on its borrowed funds, and this can be calculated by looking at the company's existing debt or market data. Typically, companies use the yield on their outstanding bonds or other forms of long-term debt for this input. However, it's important to note that the cost of debt is not simply the stated interest rate, but the after-tax cost of debt, which reflects the tax benefits associated with interest deductions. For Heinz, we assume the cost of debt by looking at the rates associated with an A-rated corporate bond. Using a bond rating reflects the relative creditworthiness of the company. For example, a company with an A rating has a lower risk of default compared to a company with a triple B rating, and therefore it would have access to cheaper debt. If we make incorrect assumptions about the company's credit risk, the cost of debt calculation may be inaccurate, which could skew the weighted average cost of capital. Assumptions about the risk-free rate. In calculating the cost of equity using the capital asset pricing model, or CAPM, one of the first assumptions involves selecting the risk-free rate. The risk-free rate represents the return on a virtually riskless investment, and for this purpose, the yield on long-term U.S. government bonds, typically 10-year Treasury bonds, is commonly used as a proxy. However, selecting the wrong maturity for the government bond can also lead to an incorrect weighted average cost of capital. For instance, using a short-term government bond yield, such as a 1-year Treasury bond, would not be appropriate for long-term investment decisions because it does not adequately capture the long-term risk expectations that are central to Heinz's business decisions. Long-term projects require long-term rates to ensure that the discount rate reflects the time horizon of the cash flows. Furthermore, the risk-free rate is influenced by economic conditions. In a low interest rate environment, such as during economic recessions or periods of government monetary stimulus, the risk-free rate is artificially low, which could lead to underestimating the cost of equity and hence weighted average cost of capital. Companies must periodically reassess this rate to ensure that it reflects current market realities. Assumptions about beta and market risk premium. The cost of equity calculation also depends heavily on assumptions related to beta and the equity market risk premium. Remember, beta measures the stock's volatility in comparison to the market. A company-specific beta can be more volatile and less reliable, particularly if the company has gone through recent structural changes. Using an industry beta, which averages the betas of other companies in the same industry, may provide a more stable reflection of the firm's true risk profile. The equity market risk premium is the extra return that investors demand for taking on the risk of investing in equities versus risk-free assets. This premium can vary widely depending on how it is calculated. Historical premiums are often used as a baseline, but forward-looking estimates based on market conditions may offer more accurate inputs. If the market risk premium is set too high or too low, the calculated cost of equity could misrepresent the actual risk being faced by the company. Incorrect assumptions in these areas can result in significant errors in calculating the cost of equity and, consequently, the weighted average cost of capital. If Heinz's beta or equity market risk premium is inaccurately assumed, it may over or understate the company's required return, leading to flawed investment decisions. There are also assumptions made about capital structure, debt versus equity. The proportion of debt to equity in a company's capital structure significantly affects WACC as well. One assumption we make is that the capital structure remains constant over time. However, companies frequently adjust their mix of debt and equity based on market conditions, or new investment opportunities or corporate strategy. For example, if Heinz decides to take on more debt to fund a large acquisition, this would lower the weighted average cost of capital. On the other hand, taking on too much debt can increase the company's risk of default, which would increase the cost of both debt and equity over time, thereby increasing weighted average cost of capital. As we have seen, several key assumptions in the weighted average cost of capital calculation impact the result. Cost of debt. Should we use long-term or short-term debt rates? Remember, for long-term investments, a long-term debt rate makes more sense. Cost of equity. The choice of the risk-free rate and the market risk premium is critical. We must decide whether Heinz's company-specific beta or an industry beta is more appropriate for our calculation. In your discussions, Be sure to justify your position regarding these types of assumptions. Why getting these assumptions right matters. Inaccurate assumptions about any of these inputs can lead to a miscalculation of weighted average cost of capital, which in turn can impact the company's investment decisions. A low weighted average cost of capital may make projects appear more attractive than they are, leading to overinvestment or acceptance of risky projects. Conversely, a high WACC may cause the company to miss out on valuable investment opportunities that could have added shareholder value. This is why periodic reassessment of the weighted average cost of capital is crucial. As market conditions and the company's own financial situation change, recalculating WACC ensures that it remains a reliable and accurate measure of the company's required rate of return for investment decisions. Weighted average cost of capital is also referred to as the opportunity cost. It represents the rate of return investors expect from investing their money in a project with similar risk. If a company's return does not exceed its weighted average cost of capital, it may not be creating value for its investors. Weighted average cost of capital is more or less an estimated discount rate. In practice, weighted average cost of capital is an estimate used by companies as a discount rate for capital budgeting decisions. Since it reflects the overall required return on a company's capital, both debt and equity, it serves as a benchmark to evaluate the profitability of potential investments. However, because WACC incorporates various market-driven variables, such as cost of debt, cost of equity, and tax rates, it is subject to fluctuations based on economic conditions and the firm's risk profile. Therefore, WACC is not an exact science, but rather a reasonable approximation of the minimum rate of return that satisfies both debt holders and equity investors. In real-world settings, the precision of WACC is often relaxed. Firms treat it as a practical estimate for decision-making, recognizing that it captures market risks and company-specific factors without being overly detailed. For example, the cost of equity is typically estimated using CAPM, while the cost of debt reflects current borrowing costs. Using long-term debt rates for long-term projects. Most capital projects span many years, and as such, it is prudent to use long-term debt interest rates when estimating weighted average cost of capital. Short-term debt may be cheaper, but it does not align with the duration of most capital expenditures. Instead, long-term debt rates are used to match the lifespan of the cash flows being discounted. The rationale for this is simple. Capital projects are expected to generate returns over the long term, and using a long-term debt rate provides a more accurate measure of the costs associated with financing those projects. This ensures that the company is comparing its long-term financing costs with its long-term returns. In this case study, if Heinz is considering a multi-year capital investment, it should calculate weighted average cost of capital using the yield on long-term corporate bonds rather than short-term debt. This matches the debt horizon to the investment horizon, offering a more accurate discount rate for long-term financial decisions. Many theoretical details are ignored in actual practice. Therefore, it is best to keep things simple. Although weighted average cost of capital has a strong foundation in financial theory, many of its intricate details are simplified in real-world applications. Financial professionals, for example, might use rough estimates for inputs like the market risk premium, beta, or debt-to-equity ratios, rather than the theoretically quote-unquote correct values derived from academic models. In the real world, precision often takes a backseat to practicality. Companies simplify the WACC calculation to ensure it remains useful as a decision-making tool without becoming bogged down by its complexity. This approach recognizes that small inaccuracies are often not material to the final decision, so businesses focus on broad accuracy rather than pinpoint precision. By simplifying assumptions, such as averaging past market risk premiums or using industry betas, finance professionals make WACC easier to use in the day-to-day decision making. The takeaway here is that WACC's utility lies in its practicality, not in its theoretical purity. Recommended reading: Best Practices in Estimating the Cost of Capital. For a deeper understanding of how weighted average cost of capital is estimated and used in the real world, consider reading this article by Brotherson, Eads, Harris, and Higgins titled The Best Practices in Estimating the Cost of Capital, an update. This article provides valuable insights into how companies estimate their weighted average cost of capital, detailing common practices, challenges, and the evolving views on cost of capital in the post-financial crisis landscape. This reading will highlight the trade-offs between theory and practice in estimating weighted average cost of capital, helping you understand better why companies might choose simplicity over complex theoretical calculations when making financial decisions. In summary, weighted average cost of capital is an invaluable tool in corporate finance, but in practice, it is often simplified to fit the real-world needs of businesses. Using long-term debt rates for long-term projects and simplifying complex theoretical details allows companies to keep WACC practical and actionable in decision-making. Understanding how WACC is estimated and knowing the limitations and assumptions involved are key to making sound financial business decisions. This concludes part 1 of this week's live chat series. As always, let me know anytime you have questions about the assignment or the course in general. See you online.